Hi, my name's Jake Barber. I'm the principal of SJB Global, and we're a financial planning company specialising in helping UK and US expats overseas. Today I'm going to be discussing the UK pension changes and how it impacts individuals moving to France. So I'm going to explain what these changes are, what the rules were previously, and how it may restrict you with the rules today. So in the autumn budget in 2024, they announced that UK pensions will fall under your estate for inheritance tax. And there are some pros and cons with this. The con, first of all, is inheritance tax in the UK is quite hefty. So you have what's called a nil rate band, which each individual gets £325,000. Anything above that is taxed at 40%. So if you've got £1 million in your pension pot, and it's all liable, it's all above the nil rate band, that's a £400,000 tax bill that your beneficiaries are going to pay. The change they've made, though, another change, sorry, is surrounding your domicile status. So domicile status is basically whether or not the UK are going to make you liable to pay inheritance tax. And in the past, it was very hard to shake your domicile status, whereas today it's very black and white. So if you've been outside of the UK for more than 10 consecutive tax years, your domicile status is now non-dom, which means you would only pay inheritance tax based on your UK-based assets. So if you've got property in the UK, you've got bank accounts in the UK, investments where the investment account is UK-based, and also UK pensions. Okay, these will be your UK-based assets. And this creates many planning opportunities, because if you are going to be moving to France, you want to keep everything outside the UK if there is going to be inheritance tax liability. So if you've got, as an individual, more than £325,000 in the UK, you would want to make sure you can move as much outside of the UK as possible. And very simple things could be moving your investment accounts, moving your bank accounts. Pensions, though, now are quite sticky, because in the past, what you could do, so prior to the budget change, you could transfer into either a international SIPP, which is a UK-based pension scheme available for non-UK residents, and they are slightly different to UK SIPPs available for UK residents, because a UK SIPP could have restrictions on accessing the funds in retirement, it could have restrictions on death benefits, it could only pay out, for example, to a UK bank account, and the investments will be restricted to just GBP denominated investments. Whereas within an international SIPP, it is still a HMRC registered pension scheme, but the investment platform where you buy and sell the investments, that sits offshore. So you can have multi-currency platforms, you can buy funds or ETFs outside of the UK, you can buy effectively whatever you want, because a lot of these platforms are open architecture. And most importantly, there's no restrictions to accessing the funds, there's no restrictions on the death benefits, and you don't just have to get paid out into a UK bank account. So you could effectively get paid out into a Euro bank account if you've set up the SIPP in euros. So many different reasons and benefits for doing so. If you are going to go into an international SIPP, it has to go through a financial advisor like ourselves. You don't have the luxury of being able to set one up yourself. But with a QROPS, so this is where in the past people would have recommended a QROPS and it's changed over the years. So every year they made changes and made it less and less attractive. But generally speaking, before this change happened, going into a pension was what's called a benefit crystallisation event, which meant the whole pension was tested against the lifetime allowance on transfer. And that meant you never had a lifetime allowance issue. But they abolished that actually at the beginning of 2024, which sort of meant QROPS were somewhat not that attractive. You'd get paid gross of tax, whereas within a SIPP you wouldn't. The 25% would be paid gross of tax, but the other 75% is tax at source within a SIPP. You can claim that tax back or get an anti-tax code, and it is paid gross of tax, but it's not a simple process. Whereas within a QROPS, it was always paid gross of tax. So there weren't too many benefits even with the change, but with the change now, unless the QROPS is based in the country of where you're living, there is a 25% tax charge on transfer. So if you've got £1 million, you've gone into a QROPS, you're going to end up with a 250 grand tax bill as soon as you transfer the pension. So if you're doing that to avoid a 40 10% inheritance tax bill, it may not be the best strategy because you still could be liable to inheritance tax in France. France and the UK both have what's called a spousal exemption, which means you can pass assets between spouses with no inheritance tax whatsoever. So if it was a case of trying to avoid inheritance tax, there are different strategies that you can do. And I think speaking to a financial advisor to break what these strategies down are is probably the best move, because it's not black and white. Everyone has their own family structure and the ways in which they want to pass their assets on. But the benefit with things like pension schemes is you can actually distribute the assets however you want. Whereas in France, it works off of civil law, which means they have forced heirship. Depending on the type of product that you use in France means that you may be restricted to who those assets go to. So that is the main change that's happened. I would also touch base on the fact that in France there are tax planning opportunities to take the money out of the pension as well, because on the first withdrawal you can pay a significantly reduced tax rate, and it depends on whether you're retired or not. So if you are looking for ways to maybe strategically take money out of a pension scheme, it is also worth speaking to a financial advisor to see what those options are.